Let's get more on Netflix's earnings. Bring in Fast Money friend and Loup Ventures founder Gene Munster. So, Gene, what'd you make of the quarter, and what is this change in how they report subs?
So I haven't got through the detail on the mechanics of the change, but the net of this is that they beat the sub number by 15%. Now, the initial take was they had slightly missed it, but they actually did exceed it. And so I think that that's an important part as they're continuing to add subs. I think that the bigger questions related to the call tonight, I think somewhat related to Tim's question too, but just around the pricing and separately the content spend. I was in Los Angeles yesterday. I met with a couple executives from the industry that are working closely with Apple and separately Netflix and Amazon, all the players. And they talked about the content spend is effectively going to double for doing these productions, this original content in the next 2 years. And so I think those type of elements need to be teased out in the call.
Okay. What are some of the other remaining questions that you have, Gene, about this quarter? I mean, what is striking to me, and we were discussing this on the desk, is the stock reaction. I mean, for the past 10 quarters, the average move on the back of earnings has been plus or minus 8% or so. And this is a relatively muted move with a stock that's up 50% from its lows going into the print.
Yeah, I think that people who are optimistic about the Netflix story, I'm less optimistic longer term about it, which we can talk about later. But I think those people should feel good about just down 2 or 3%, given the fact that the upside, well, there was upside. This still trades at an 85 times earnings multiple. I know earnings isn't the key here, but just to put that into perspective, is Amazon trades at a 65 times. So this is measurably more expensive than Amazon. And what that means is that you need to continue to have some more substantial upside. So if I would have seen these numbers before they came out, I would have bet that the stock would have been down a little bit more than it is right now. So I think that the people who are supportive should feel good about the reaction.
Gene, I'm not comparing Apple to Netflix, but I'll make this comparison. When Apple changed the way they were doing things, stock went from basically 210 to let's call it 140, 145. Should Netflix be punished similarly?
Right now, I think that a lot of people are still, present company included, trying to figure out exactly what the mechanics of this change were. And so that reaction may ultimately be coming. And so in the case of Apple, the reason why the reaction was so swift, it was just a very easy thing. They were disclosing the iPhone units, then they were not. And so it was relatively quick to get your head around it. I think this case might be a little bit different. But I think it does speak to a difference in the way investors view a story like Apple versus these higher growth stories. And I think that they're much more lenient on negative news when it comes to stories like Amazon or Netflix.
Gene, how do you figure out how to value something like this?
So you cannot look at an earnings ratio because there's really no historical justification. I think what investors need to do is think about how disruptive can these companies be, and think about other areas that they can change. I think if you look at the FANG stocks, several of them, if you think about Amazon, Apple, Google, they will all change the world dramatically. So it's easier to build cases for higher multiples for those stocks, even though Apple's been penalized. In the case of Netflix, they're not going to change the world again. Their business model is not going to be different. And so the simple answer is I struggle with that question about how to value Netflix because, well, I think they're doing a lot of good in terms of capturing broadcast eyeballs. I do not think that this company should have an outsized multiple given they probably aren't going to make a dramatic change to our lives in the next decade.
Gene, you said you're not extremely positive on the Netflix story going forward. And so I'm wondering if you're, for whatever the reason may be, are you seeing signs of that appear? Are there cracks in the story that you're seeing in this quarterly report?
There's two things. First is impressive price increase. The speed of the price increase was a little bit faster than it happened. It was just under 2 years, and most people think that would be 2 to 3 years. That's coming from a sign of strength. So I understand why people are optimistic. But every time you do that, every time you take a step forward like that, it sets the bar even higher. I think back to what happened to Apple in 2017. They raised the pricing, and that became a near-term kind of a 6-9 months positive impact on the stock, but it actually created a higher bar for the future. And I think that even though there is pricing leverage with Netflix, I think that that bar just got higher. That's one piece. The second is that this competition is going to be more impactful in the next 2 years. And if we think about CBS, Disney, Prime, Apple, all of these, people will have multiple subscriptions. I want to be clear about that. But the issue here isn't about whether they have multiple subscriptions. The issue is more competition can have a negative impact on the multiple as investors think about different options. The Fortnite comment really jumped out at me, and I think that that is another X factor here that impacts our longer term, is that the company needs to navigate that shift in terms of content for the younger audience.
What's your grade, Gene?
We're going to give it a B. And ultimately, for this kind of high multiple stock, you just needed to do more to earn a higher grade.